Okay, so partnerships, termination, and liquidation. So the last chapter we saw from the perspective of starting and distributing income, adding partners. But what happens when a partnership terminates and liquidates, or one or the other? Why would they terminate? Well, termination of business activities is followed by liquidation of partnership property. You could see occurs for a variety of reasons. Personality disputes between partners, they just can't get along. They decide to go their separate ways. Retirement, death, changed business environment, low profits, bankruptcy. So these are some of the reasons. You could have guessed at most of them. So when the partners wish to terminate, though, what happens? Well, it's a normal liquidation. We convert all the assets to cash, so we sell them all off and make sure we have cash for all of them. Any kind of gains or losses are allocated to the partners, and then we pay all the liabilities and expenses that are still out there and distribute any remaining cash to the partners. It's pretty straightforward in a normal type of liquidation that happens very quickly, but that's not the norm of business. Here we go. I'm trying to advance. Okay, here we go. So here's a normal liquidation, very quickly happens. They have cash, accounts receivable, inventory, land and buildings. They have some liabilities. It's Morgan and Hausman. There's their balances on May 1st. According to their agreement, Morgan and Hausman divide profits 6-4, 60%, 40%. On June 1st, the inventory is sold for $15,000. So we debit cash for 15, credit the inventory for 22, and assign the loss on the inventory according to the profit and loss ratio. So the $7,000 loss is allocated $4,200 or 60% to Morgan and the other 40% to Hausman's capital account. They're closing up the business, so they don't have to put it in a loss account anymore and then close it out to capital. Just put it directly in the capital accounts. Assume that the 9,000 accounts receivables are collected. The remaining accounts receivables are written off as uncollectible. Well, we're no longer making income statements, so that expense, quote, of uncollectible accounts is directly debited to the capital accounts of Morgan and Hausman, the $3,000 expense, according to their profit and loss ratio. So we debit cash, credit accounts receivable for their dollar amounts, and then allocate $1,800 to Morgan's capital account and Hausman's $1,200. The fixed assets are sold for $29,000. So there's a loss on the fixed assets of $12,000. Originally they were $41,000. Again, debit cash for $29,000, credit the land and building accounts for $41,000 net, and then the loss is allocated according to the profit and loss ratio. 60% goes to Morgan's capital account. Hausman's capital account is debited for the $4,800. Now, the next thing is that all the liabilities are paid off with the cash from the business. So we debit accounts payable and credit cash. Any kind of additional expenses in liquidation are directly debited to the capital accounts of the partners, just like before, according to the profit and loss ratio. So 60% goes to Morgan, 12% to Hausman. And then cash is credited. So we're not using any revenue or expense or losses or gain accounts anymore. So here's your pre-distribution balances in a normal, straightforward liquidation and termination. There should be a cash balance of $63,000. And if you do the T accounts and update Morgan and Hausman's capital accounts for all those journal entries we just did, these will be their final balances. So the cash would be distributed to Morgan and Hausman according to their capital balances. And there it is. And now the business is terminated. We close down the capital. There's no more assets. The partnership is closed. However, I know I ran through those quickly, and there's a great summary of these journal entries on page 462. the norm of business is not to be bing, bang, boom, you're done. Okay, because various parties want to be updated on the progress of liquidation, because it takes time. A report can be prepared to disclose transactions to date, property still being held by the partnership, liabilities remaining to be paid, current cash and capital balances. So it's up to us as accountants to make sure that we are always keeping the partnership and parties involved updated to these types of items. Now, the process of liquidation can last over months, even years. Partners may also experience deficit balances during the liquidation period. Now remember, in the last example, it was a pretty straightforward, very easy type of introduction into this. The capital balances were positive. But what happens if during liquidation a capital balance becomes negative to a partner? They're in a deficit. Partners may want cash distributions prior to the complete liquidation of the partnership. How do we handle that? Accountants distribute statements at each important juncture of the process. So that's why we need to understand these different parts and processes and how we handle it. Now, deficit balances in a partner's capital account during liquidation can be handled in one of two ways. The deficit partner can contribute the money or assets to make up for the deficit, so to bring their capital account to zero. The other thing that could happen is that the remaining partners can absorb the deficit into their capital balances. And then the deficit partner may have to pay later, or even the partners who soaked up or absorbed that deficit partner's negative capital into their capital accounts, they can sue them personally for that amount. Now, let's take this as an example. Cash, the only asset during termination here in liquidation is $20,000 in cash. Holland has a $6,000 deficit before liquidation. Dossier has $15,000 and Ross has $11,000. They're positive. How do we handle this? The contributions made by the deficit partner are distributed to the non-deficit partners based on their relative profit sharing percentages. So any payments made by Holland will be split 2/3 to a Dossier or Dozier, whatever you want to say, and 1/3 to Ross. How do we come up with that? Well, Dozier and Ross share in a 40% to 20% ratio. Okay, so if we take 40% plus 20%, that's 60%. So 40/60ths, 2/3, and 20/60ths, 1/3. That's how they come up with that. So if Holland's loss proves to be uncollectible, so let's take a step back before we go into this. Take a look on page 465 of the book, 465. When cash comes in from Holland, here's what will happen. We'll debit cash for $6,000 because the partnership got $6,000. We'll credit Holland's capital $6,000. His capital balance is now zero. What's the effect for the other two partners? Well, Dossier will get his whole $15,000, so his account will be debited. Ross will get his full $11,000, and that equals the $26,000 in cash. That's a beautiful thing if that could happen. But what if it doesn't? What if the remaining partners feel they're not going to get the money from the deficit partner? Well, if Holland's loss proves to be uncollectible, they're not going to get the money to put back into the partnership, so they get all their cash. Dozier and Ross will have to absorb that deficit into their capital balances, or reduce. That's all that means, is reduce their deficit balance. Their capital balance with that deficit amount. How do they reduce it? Well, according to what their profit and loss ratio is between the two of them. And that's where we said it's normally a 40% and a 20%. That equals 60%. So 40/60ths of it will be absorbed by Dozier. 20/60ths, or 1/3, will be absorbed by Ross. And you can see on this slide that $6,000 loss, $4,000 will reduce Dozier's capital balance. Ross will reduce his $2,000. So these represent the maximum potential reductions that the two remaining partners could still incur. Depending on Holland's actions, they may be forced to do this. They may be forced. But what if they're not? Okay, what if they're not forced to do it at this point? Well, if they want their money now, okay, they will take what's called a safe payment. And what that means is they're going to figure out, well, what would be our payment if we were forced to absorb Holland's capital balance? Well, they have to reduce each of their capital balances by the amount that they would have to absorb. So the capital balance that would go to Dozier is $11,000 and Ross would get $9,000. So they will be able, so that equals the $20,000 cash balance. They would be able to take that much of the 20. That's how they would split up that 20,000 that is there. So if they want their money early before a full liquidation. And there it is. Dozier's distribution of 11 cash reduces his capital account from 15 to a minimum level of $4,000. He has to have 4,000 in there to absorb his portion of Holland's deficit. Likewise, a $9,000 payment to Ross decreases the $11,000 capital to $2,000. So these safe payments can be distributed without fear of creating new deficits in the partnership in the future, because they're not doing anything else. They're just waiting for Holland to decide if he's going to give them the cash or if they're going to have to go after him. Okay, now what happens if prior to making an interim cash distribution to the partners, we assume all non-cash assets will be complete losses, all liabilities will be paid, and all deficit partners will be written off. This is what we call a schedule of liquidation. Let's see if we're kind of skipping around here, I believe. Okay. Yeah, we're over on page 471 now. So under the Uniform Partnership Act, which is our act that governs partnerships, a priority ranking of creditors having claims against individual partners is recognized. So we have to make sure we're paying off debts owed to partnership creditors, debts owed to other partners, and debts owed to personal creditors. We have to take those into account. Individual partners' creditors can make a claim against the assets of the partnership. So all partnership creditors must be satisfied first, and then the creditors can only assert claims to the extent of a specific partner's positive capital balance. So there's a lot more involved here. And as accountants, we have to make sure we understand all of these different forces that could affect this distribution of money to the partners. Each partner is liable for all the debts of the partnership. Partners are never liable for the personal debts of the other partners, but a partner may use their partnership balance as collateral on a personal loan, and that's what we have to be careful of. So used by accountants to guide the distribution of cash resulting from the liquidation process is called a pre-distribution plan. So we're going to use an example here. We're going to use this balance sheet. It is it's not the one that's in the book. It's actually a different one, which is very interesting. So this is good. We have cash of 0, non-cash assets of 221, liabilities of 100,000, and these are our capital balances here. We're going to make a pre-distribution plan. First of all, determine the maximum loss that each partner can absorb. So we divide each partner's capital balance. Each partner's capital balance, maybe it is. I'm sorry, it is. It's on page 475. I was looking at the wrong one. On page 475. Each partner's balance, and we determine, based on their income sharing percentage, how much of a loss they can actually absorb into their capital before becoming a deficit. So the maximum loss that Rubens can absorb is 60,000, 30,000 divided by 50%. Smith can absorb 200,000, 40,000 divided by his income sharing percentage of 20%. And Trice can absorb a maximum loss into his capital account of 170,000. Now when we're saying that, we're saying a partnership loss, because that's how much of a percentage they take on. All right. So since Rubens can only absorb a partnership loss of $60,000, new balances are computed assuming that the partnership has a $60,000 loss. So we're just assuming this. So if that's the case, Rubens' capital at a $60,000 loss will be 0. Smith's capital will be reduced by 12,000, so his new capital balance would be 28,000. Trice's capital balance goes down 18,000, so his new capital balance is 33,000. So now Rubens is out. With Rubens wiped out, we continue calculating the maximum absorbable losses using income sharing percentages between Smith and Trice. Now remember, Smith has a 20%, Trice 30%. We're just going to focus on those two. So together that's 50%. So 20% of 50% is 2/5. So for any remaining loss absorption, these are the percentages we're using. 2/5 for Smith, 3/5 for Trice. Let's take a look. As earlier, compute the maximum absorbable loss by dividing the capital balances by the relative income sharing percentage we just came up with. Well, Smith, based on his new capital balance of 28,000, 40% income sharing, can absorb a $70,000 loss. Trice, based on his new capital balance of 33,000 and income sharing just between him and Smith of 60%, can absorb a $55,000 loss. After this computation, here's what's left. The remaining balance to Smith is 6,000. Trice is out. With Rubens and Trice both wiped out and Smith left as the only remaining partner, the pre-distribution plan can be prepared. So, to inform all parties of the pattern by which available cash will be dispersed, the pre-distribution plan should be formally prepared in a scheduled format prior to beginning liquidation. So what they're saying here is available cash, the first $112,000 must be paid to creditors and liquidation expenses. The next $6,000 will go to Smith. He's the only one that would have a balance at the end. The next $55,000 will be shared between Smith and Trice. And then they'll share in all the remaining cash. And then this would be an appropriate way of distributing cash before complete liquidation. Now I know the PowerPoints here skipped over some pages in some of the remaining pages before we started looking at the distribution of, or I'm creating a pre-distribution plan. So if you have any type of questions on those, I think they're pretty straightforward. We hit all the major areas as far as liquidating the partnership or termination of the partnership, whereby we liquidate all the assets, pay the liabilities, and pay off the capitals. If there's a partner that's insolvent, how we handle that. And if it's going to take a while, especially, which is normal, how to create a pre-distribution plan so the partners know exactly what they're eligible to get as liquidation occurs. So partnerships may be terminated for many reasons. When terminated, remember, partnerships assets must be sold, liabilities paid, and then we handle with the capital balances. Actual liquidation can require an extended period, so it promotes the use of proposed schedules of liquidation so partners always know what they're eligible to do and have. Pre-distribution plans may be necessary when one or more partners have negative capital balances. And that concludes. I know it's a very short lecture this time, but that does conclude Chapter 10. So as I said, as you're going through, if you have any questions, please be sure to email me or post them on the discussion board.